Welcome to TheoTrade. This is Don Kaufman. April 8th, 2022. We are minutes after the cash close here on this Friday afternoon. Is the market at a crossroad? We're going to answer that and much more here on this weekend's update. First and foremost, you're going to jump right into the SPX, the mother of all products. By the way, that always comes up like, why? Why call it the mother of all products? Well, first and foremost, the SPX really drives a lot of order flow to the rest of the marketplace. Think about how many products are based in terms of, well, S&P 500. But one of the reasons we call it the mother of all products, you realize the SPX today, all right? This is not exactly like the most rocking day in the market, but the SPX today did 1.6 million contracts. And if you think about that in terms of like notional value, what does that mean? I mean, I'm sure a lot of people turn around and they say, well, but take a look at Tesla. What did Tesla do? And Tesla being $1,000 stock, and Tesla did 1.4 million contracts. Yeah, the only problem with that is Tesla's $1,000 stock, and the SPX it's $4,000, almost $500 product. The notional value trading through the SPX is unlike no other product. And what happens is the SPX doesn't necessarily have any stock behind it. So how do you hedge it? The S&P futures. The futures are actually pushing the market higher and or lower, but it's the SPX order flow that kind of dictates what the trade is going to be inside of the futures contracts. So to kind of back up for a second, the reason I'm mentioning this is the market this week. It was facing headwinds, and just that risk continued to kind of accumulate. I'm standing here and I'm looking at the markets and I'm thinking to myself, I'm like, wow, given the fact that the FOMC came out, they were wildly hawkish, right? They were talking about, of course, the deterioration, if you will, quantitative tightening, and $95 billion a month coming off the portfolio that they're presently holding, even selling mortgage-backed security. I got to tell you, that was a headwind. Another headwind, of course, the bond market, which we're going to look at here momentarily. And the blows just kept coming throughout the course of the week. The market, it held on. And when I talk about it holding on, what did it hold on to? The edge of the expected move. And it's critical to kind of understand this stuff. For those of you that don't recall what the expected move is, the expected move is derived, and that's the three lines on your screen. There's an upper line, there's a lower line. This central line, okay, that one is that's where the week started. But the upper edge and the lower edge of the expected move. The expected move this week was roughly plus or minus approximately $75, plus or minus $75. So you're looking for this move, the $75 higher or $75 lower. And that entire, justification comes from the options marketplace. And again, options are handicapping what the next week is going to look like. Like right now inside of the S&Ps, you go out to next week and we look at like April 14th, it's looking like about a $77 move. So the volatility, if you will, and the expected move is similar, okay, of course, to the week we just passed through. Nevertheless, okay, look how efficient this marketplace happens to be. We were holding on, okay, to the edge, holding on that lower edge of the expected move from Wednesday, Thursday, Friday. Your entire trading week really came down to, and now I'm actually going to look at it. Instead of going back like a day, I'll take you back like 4 days and hit OK. And what we'll do, this is all the way down to 1 minute. We'll get crazy. We'll move it up to like a 10-minute chart just to display, all right, what the entire week came down to. And again, this is zoomed in on, of course, more of an intraday basis. The week started out maybe a little higher. Remember that central line, that's where the week started. We, break a little higher, start coming off a little bit. All of a sudden, the market gets violent to the downside on Wednesday. We just skirted the edge of the expected move all day Wednesday. All day Thursday, came off a little bit to the upside. What did we do Friday? Came down to the edge of the expected move, skirted it throughout the course of the day. We held the edge of the expected move, which is actually a sign, if you will, of efficiency in the marketplace. In fact, okay, that in large part, it's not about what you think, what you know in the marketplace. Okay, it just has to do with hedging, and hedging drives moves, right? Why do you think I just spent the time to talk about the fact that, 1.6 million contracts traded today? Why is that so important? That's exactly why it's important. It's important because those contracts, okay, are predominantly being rolled in the real short duration stuff. And it's those contracts that are going to drive hedging in the S&P futures all throughout the course of next week. So if you will, like looking at this expected move, it's like an averaging formula, okay, of an entire option chain. And again, it's what drives markets. And this is where people, they get, so into like, oh, I'm looking at Apple and I'm looking at Tesla. Well, okay, it's great. But even these products are definitively impacted by the movement of the S&P, or more likely to look at SPX and understand that SPX, expected move is just essential. Anyway, we held on to the edge of the expected move. As I said, it's one of the most critical things to think about, because had we actually broken down, this marketplace is going to get downright ugly. Here's the key right now to markets. I'm actually going to cruise over to the spiders. Okay, and before I go any more detail in here, a lot of the times people get very hung up on directional bias. I'm so bullish, I'm so bearish. I mean, that's what we're bombarded with every single day on CNBC, or, you turn on anything that's, financial media. What do you think the market's going to do? Oh, I don't know. What do you think the market's going to do? And the reality is right now, I'm going to tell you, that's why I call it. It's marketed a crossroad. All right. This crossroad, though, it does not have equivalency for risk reward. What I'm doing on the screen right now, I'm just trying to highlight, like, look, this is where the market presently is, all right? And what I want you to think about is upside potential, okay, versus ultimately downside risk. And again, try to be as objective as you possibly can, because I'm going to zoom out for a second. I want you to think about upside potential near term. Don't tell me about anything out beyond 3 months from now, but near term. What's the upside potential versus some of the downside risks? And you know that there's some headwinds in the market, but let's get all kinds of crazy. All right. Could the spiders claw back all the way to 470? Possibly. I mean, I really, it's possible. There's no question about it. But that would be some pretty substantial upside, given the fact that we've already sustained some substantial upside. So let's call it 470. And again, I'm not trying to justify anything over here. Just giving you realistically where I think we could have an explosive move to the upside. Some of the geopolitical risks subside around the world, yada, yada, yada. It would take those, kind of action for the market to continue to sustain the rally. The problem, though, that you have right now is you face some of the downside risks. Okay, and they're deep. Okay, and that is something that's it's unequivocal that again, taking a look at downside risk, if we start to sell off, okay, again, you have to recognize that then permits everybody that's ever been bearish is going to go, we're back to the bear market. That this entire move to the upside was probably nothing more than a bear market rally. You could probably make that argument to some degree already inside of the QQQ. We're getting dangerous. Right? And from this point forward, like you can't think about like I'm bullish or I'm bearish. You have to understand that because we've been labeled into the bear market in the Nasdaq, the upside potential is there. The downside risk, though, okay, is phenomenal. Downside risk is huge in the present market environment. All right, there's no if and or but about that. Now, to kind of further that, and again, that doesn't mean I'm all bared up with no place to go. Listen, I show every position that I have on, for better, for worse. I got bearish positions on. I got a couple of bullish positions on, mainly in the metals. But, and I'll show you exactly what my positions are here momentarily. I want you to understand risk reward. I think it's one of the most essential things right now moving forward. You can get bullish, but if you're going to be bullish, be defensive. Use spreads if you can. All right, forget about it. You can't be long futures. You get killed. You're going to wake up one day and the S&Ps could be down 100 handles when you wake up. What are you going to do then? Right? This is going to be a vicious marketplace if we actually do turn and burn to the downside. All right, with that, as I said, we were holding on to the edge of the expected move and we held it. Okay. Dollar. Let's actually cruise over to the dollar. So I still carry some positions in the dollar, and I'll talk about that in my positioned statement. But I still carry some positions in the dollar at this point. Long dollar. Dollar's starting to break out. I don't look at this as being a very friendly place. Why? Because right now what you're seeing is the marketplace is looking for places as duck and cover. It looks like the dollar is one of those duck and covers, meaning that it's kind of like, where are you going to go? I mean, where are you going to go in this marketplace? You're not going to buy bonds. Have you seen bonds lately? We're going to look at that momentarily, but you're not buying bonds. Where are you going to go? right? People are actually shoving money into the dollar. Like nobody wants to go, oh, I really want to buy those euros. Okay. I mean, the only thing that's actually been up lately other than the dollar, you're going to believe this, even the Russian ruble has actually recovered, right? Nevertheless, right, the dollar, this is almost like the new VIX, and it's been exploding to the upside. And again, I've been long dollar and been long dollar for some time. Moving onward and upward, bonds. Bonds are breaking apart, not breaking out, breaking apart. And this is where, and I don't mind saying this right now, earlier in the week, I was talking about the yield curve, talked about the yield curve the last couple of weeks. That conversation is over and done with. No one gives a crap. That already happened. The yield curve inverted. We told you it would invert 6 weeks ago. It inverted, and it inverted in a big way. At this point, all we care about, wow, interest rates are exploding. This is something I don't look at too often, but if you look at the FVX, what is the FVX? Actually, the 5-year. Realize the 5-year crested almost 2.8%. And you go, well, what's the 10-year trading at? And we'll bring up the 10-year. 10-year is trading 2.7. Again, the 5-year has exploded beyond the 10-year. You bring in the 30-year over here, rates have exploded. And again, the best way that I can present this, if you take a look at the FVX, best way I present it on a year-to-date basis. Oh, don't worry, rates are only up on the 5-year, only 100%. They're up 100%. They're not up to 100%, but they're up 100% on a year-to-date basis. So interest rates are exploding. But what I want to give you on this point, all right, first and foremost, this sell-side activity inside of the bond market, to me, okay, I like it. I like it. In fact, I wasn't going to go into this, but we're going to go for it anyway. I've actually been selling bond puts. Okay, I have. Why do I do that? Because I actually want to be in the long bond business at this point. Because I'm going to tell you what, this has been a precipitous sell-off. Can the sell-off continue? Absolutely unequivocally, yes, it can. But I'm actually comfortable selling puts over here because I don't mind. I would take the bonds at 138. I would buy the bonds at 133. I'd buy the bonds at 132. Load them up over there. But I don't mind being long bonds. This is absolutely cratering. What you're going to find out, though, this next week of trade, everything in this next week of trade is going to be very, very data dependent. When I say data dependent, like CPI is coming out. The other big one, ECB announcement. ECB might get all kinds of hawkish. They may turn around and say, like, let's do this, man. Let's jam rates up on them. These are some important announcements coming up. What you're going to find out is the market as a whole, okay? And just this next week of trading, oh, man, every single data drop is going to rock markets. Like that's the risk that you're going to be in right now. Like if an inflation report comes out, it gets a little hotter than expected or a little weaker than expected, the bond market might be breaking apart, but it's going to be so data dependent moving forward. Mark my words, be careful in the bond market. All right, bond market, if that inflation data did come in and it was hot, these bonds are going to sell off even more. But as I said to you, I got to pull up a 5-year chart to see price action all the way down like the 130, 136. And I'm over here selling bond puts, but I'm selling like 138, 133s, 132s. Listen, bring the pain at this point. So forget yield curve inversion. Anybody talking about that is now 6 weeks behind the yield curve. Now, literally, they're 6 weeks behind. The next thing that you really want to start to pay attention to in this marketplace, okay? So we're at this kind of crossroad in the market. And that crossroad is between kind of like, all right, a little bit more upside potential versus some pretty wicked downside risks. But one of the things that's really missing right now, the correlation coefficient is not there. People are looking at advanced decline line. I know many of you trade on an intraday basis. So do I. I happen to look at the S&P 100. Why don't I look at the S&P 500? Well, because no one cares. There's 400 stocks, don't even matter. Quite frankly, we don't even need S&P 100. You could have like the S&P 20 at this point because the market capitalization of a Microsoft, of an Apple, of an Amazon, of a Tesla, of an Nvidia, like it just doesn't matter. Nothing else matters anymore. But I want you to look at the advanced decline line because there is a little bit of a tell in the AD line. Markets are not correlated at all. So you saw some sell side activity throughout the course of this week. As I said, the market, slipped down a little bit, but there were some stronger areas and some not so strong areas. And what you're actually seeing is a lack of correlation. Why do I bring this up? I'd keep a good eye on this because if we get correlated, and I'm going to be very clear, the correlation could be the upside or the downside. It's dire for this marketplace. Watch out, okay, for a heavy advanced decline line in either direction. That would be, if there's going to be a signal, it won't matter if it's to the upside or the downside, but I'm going to tell you right now, even if you see 90 stocks trading to the upside, 10 to the downside over here, look out. That's going to be dangerous. High correlation coefficient could actually flip over in a second. There hasn't been good correlations, all right, and that has been now for, well, here, take a look. If you actually want to see where the correlation coefficient really died down, it's been really like that last almost 3 weeks of trade. So even this last week of the burst of the S&Ps to the upside, we just lost the correlation coefficient. We're 3 weeks out of it. And I'm going to tell you right now, even if we correlate to the upside, I would look at that as very, very extreme and get ready to rumble at that point in time. So what you're seeing right now inside of the marketplace is it's basically sector rotation. They're just playing the sector rotation game. So it's like a game of hot potato. Let's move into the financials. Well, you know what? No one wanted to touch the financials. Look at the financials. Really, last week, and again, I just want to enunciate this. Last week, the financials broke the expected move, right? What do you got? This week, they actually hit the edge of the expected move, broke out, bounced today, right? Anything getting beaten up, oh, that's okay. We can buy that. All right, what else are they rotating into? Some consumer staples. If you haven't looked at Walmart lately, okay, that's Walmart. Like it's the latest, greatest thing. It's Walmart. All of a sudden, we're diving into anything that's duck and cover. I mean, diving into duck and cover. This is like getting under your desk and rocking back and forth. And Goldman Sachs, you realize nobody's bought Goldman Sachs in months. I'm not being facetious by saying that. Nobody's bought anything at Goldman Sachs in months, and all of a sudden, this is the greatest thing. Oh, remember, earnings are going to start kicking off, also in the next couple of days, which is going to have an impact to the marketplace. Maybe not so much the financials, but take a look at the sector rotation game. Nobody's wanted to touch home builders. All of a sudden, those are pretty good. That's why I said when this correlation starts to pick up, okay, it's dire. Like there's no way that you're going to convince me that even a correlation to the upside is a good thing for the marketplace. As soon as we correlate to the upside, they'll flip it over, okay? Watch out. Marketplace is going to be very data dependent. Every data drop is actually going to cause a little fear trade, all right? But it's really going to come down to the correlation coefficient. When you see 85 or 90 products trading on one side, that's when you get under the desk and start rocking back and forth. All right, let's get down to position updates. Selling premium is beautiful. You realize that SKU picked up again. SKU was only, calculated at the end of the day, but SKU picked up again. SKU was actually rocking, just rocking. We hit a 146 SKU, earlier in the week, and but who cares? It's still like a 140 SKU. That means those out of the money puts inside of the S&Ps, they are juicy. If you're selling premium, it's the place to be. Okay, and I'm telling you what, I'm selling premium, but I'm also selling some premium over the ZB. I've got a bunch of positions substantiated over here on Tasty. So if you are in Tasty Works, so am I. I've actually got a number of different positions in the spiders. And again, these are Christmas tree trades that I've actually built over here. But the Christmas tree trade is designed expressly for high SKU. Next thing is long dollar. In fact, you know what? Let me actually show you exactly where my long dollar position is. My long dollar position, how do I get long dollars? I actually use the small exchange. Small exchange is it's a newer exchange. It's only been out now, we're less than 2 years since they've actually had regulatory approval, but the SFX, the /SFX, is actually a small dollar. So I've actually been long some dollars, and I roll these. I've rolled them for a couple of months over here. I'm just going to throw this out to you. I'm gonna get the point right now where I'm getting a little punchy, may actually eventually knock out of the dollar here. It's going to depend again early on in the week, but I don't know if I want to hold this dollar trade through the ECB report. That's again, it's a little sketchy at this point. We've made a lot of headway inside of the dollar trade. And again, to break out above 100, which is what we saw in the $DJX, the DJX, it's $DXY is the dollar. But the movement we've seen in here, it's been nothing less than phenomenal. So I think there'd be a little bit of follow through, but I'm getting edgy to possibly bail out of the dollar. Next one on the docket over here, I was making fun of Walmart a moment ago, but you got to take a look at the XLU, the utilities. Okay, all of a sudden everybody wants to buy utilities. As I said, it's playing the sector rotation game. As soon as this rotation game stops, the music's going to stop for the entire marketplace. Last but definitely not least, by the way, I want to make this clear in the XLU. I am short. that means I want it to go down. And I've got a lot of different positions in the XLU, one of them which sticks out like a sore thumb when you got 5,000 contracts, because again, when I execute, other people execute into it. The other position I've actually got going is inside of SLV. So I executed into this position literally today. And you can see the contract size in here is nothing less than spectacular as well. This happens to be a bullish position in SLV, and I'll tell you exactly why I'm taking a bullish position in here. So am I super bullish in silver? No, not so much. I mean, silver's just been kind of, categorically speaking, chopping around. I think there's going to be a little upward bias because the dollar has gotten a little over its skis. When the dollar pulls back, I think it's actually going to push some of the metals a little bit higher. That little bit higher is enough to see degrees of profitability inside of silver in the near term. It's just a handful of positions. As I said, selling premium, it's where it's at. I'm actually selling premium inside of the bonds, trying to get long some bonds. I'm long dollar, getting ready to bail. XLU, I'm definitely short in there. By the way, I'm short in several different ways in the XLU. I've also inside of my IRA. In the XLU, let's go ahead and bring that up again. In the XLU, I've also got what I call duration positions. These are deep in the money puts to actually create synthetic short stock positions. And last but not least, of course, entering into the SLV today. All right, last, definitely not least, we always take a look at the SPX, again, the mother of all products. As I was saying a little while ago, in the SPX, right, I actually handicap exactly what the movement should be inside of the SPX, predicated on these expected moves. So what's the expected move this next week? You're going to see it's blank in here. No, the expected move. The SPX only closed 15 minutes ago. The expected move is going to be $76.71. Again, $76.71. And you'll actually see me kind of draw this out on here. $71 higher, or sorry, $76 higher, $76 lower. The expected move, though, and the reason I like to handicap this, it's almost identical to the previous week. So what do we have in store? Well, a lot of the same as the previous week. However, I'm also going to throw this out here. It's been a few weeks since we've had any substantial breaches of expected move. And a few weeks before that, a few months before that, before we had another major breach. Look out this next week, okay? Just from where I sit right now, okay? That expected move looks low versus some of the risks that we're actually seeing in this marketplace. It also looks incredibly low versus the fact that this marketplace really is at a crossroad. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.